Hello guys, welcome back to my channel where we learn how to grow our wealth slow and steady. Today's topic is very important because it's about 7 foolish money mistakes that keep you broke. I'm going to share with you some of the most common mistakes people make when it comes to their finances, why they are so detrimental, and how to fix them fast. These mistakes might be simple, but they can have serious consequences if not addressed. So make sure you watch this till the end, because each point has its own golden nugget. Now, before we get started, please subscribe and like this video so that you never miss out on any future videos. Also, feel free to comment below if you have any questions or if you want to share your own experience. Now, let's dive right in. Mistake number 1, investing in things you don't understand. Imagine buying a stock because your friend recommended it without doing any research yourself. What happens if that stock suddenly drops in value? You might panic and sell, losing even more money. This is the danger of investing in things you don't comprehend. It's like attempting to drive a car without a license. Sure, you might get away with it for a while, but eventually you'll crash. The same holds true for investments. If you invest your hard-earned money without understanding what you're putting it into, you're taking a huge risk. You could end up losing everything. So how do we fix this? Simple. Educate yourself. Take the time to learn about the investment options available to you. Don't rely solely on others' opinions. Do your own research and make informed decisions. Remember, knowledge is power when it comes to investing. And by educating yourself, you're empowering yourself to make smart choices that align with your financial goals. Mistake number 2, signing a loan for someone else. Now, this mistake might seem like a noble gesture at first. Let's say your brother needs money to start his business, or your friend needs help with their medical bills. But before you put your signature on that loan agreement, think twice. By signing a loan for someone else, you're essentially telling the lender that if that person defaults on the loan, you will pay it back. That means if your friend or your brother can't make their payments, the lender will come to you. And trust me, lenders will pursue you relentlessly to recover the debt. They won't care if you have your own financial obligations to meet. They just want their money. So even if you face financial hardship yourself, you'll still be responsible for repaying the loan. Let me tell you a story. I once knew a guy who co-signed a loan for his buddy who promised to pay it back quickly. But months turned into years and your friend fell behind on payments. My friend had to make those payments and he ended up in a lot of debt. It was a huge mistake that could have been avoided. So how can we fix this? Simple, set boundaries. It's okay to help others, but don't jeopardize your own financial stability to do so. If someone asks you to co-sign a loan, politely decline. Instead, offer to help them in other ways, such as helping them improve their credit score so they can qualify for a loan on their own. Remember, true friendship means supporting each other without risking your own financial well-being. Mistake 3, falling for Ponzi schemes or scams. Have you heard about these get-rich-quick schemes promising unreal returns? Well, they're like mirages in the desert, alluring but ultimately deceptive. These scams often target people who are desperate to make money quickly. They lure you in with promises of high returns and easy profits, but in reality, it's all a sham. The money you invest doesn't go into legitimate ventures. It's used to pay off those who invested before you, creating a cycle that keeps going until it collapses. And when it does, you're left empty-handed and out of pocket. The worst part is that these scams are designed to exploit your trust and greed. The scammers create a sense of urgency, pressuring you to invest now before the opportunity is gone. They might even show you fake statements or testimonials to convince you that it's all legit. But it's not. It's a trap. Once you fall for it, there's no turning back. So how can we fix this? Simple. Be skeptical. If something sounds too good to be true, it probably is. Don't rush into investments. Do your due diligence and research thoroughly. If an investment promises exceptionally high returns with little to no risk, be cautious. Remember, in the world of finance, if you're not willing to take the risk, you're not going to get the reward. Mistake number 4, not starting to invest early. Did you know that investing early can significantly impact your financial future? Let me illustrate this with an example. Suppose you're 20 years old and you invest $200 a month in a diversified portfolio, earning an average annual return of 8%. By the time you're 60 years old, you'll have over $1 million. But if you wait until you're 30 to start investing that same amount. So why is this happening? It's all about the power of compounding. When you invest early, your money starts working for you right away. And over time, your earnings begin to generate their own earnings. It's like a snowball rolling down a hill, getting bigger and faster as it goes. This compounding effect can make you a lot of money over the years, especially when you start early. But here's the catch. Many people don't start investing until they're much older, often when they've already established their careers and have more disposable income. However, the earlier you start, the better. It allows you to take advantage of this compounding effect and build wealth faster. If you can start investing even small amounts when you're young, you'll be setting yourself up for a comfortable future. Now, you might be thinking, I'm still young, I have plenty of time to start investing. But remember, time is your greatest asset when it comes to investing. The sooner you start, the more time your money has to grow. Don't wait. Start investing early and watch your wealth grow exponentially over the years. Mistake number 5, saving money in the bank without protection. Now, this mistake might sound surprising, but let me explain. Saving money in an unprotected bank account is like keeping all your eggs in one basket. It's risky. Bank failures, fraud, and market fluctuations can all pose threats to your savings. For instance, if a bank fails, your deposits may not be insured for the entire amount, leaving you with less money than you intended. Similarly, fraud and market fluctuations can also negatively impact your savings. So how can we fix this? Simple. Diversify. Spread your savings across different financial institutions, including banks with robust insurance and those that offer higher interest rates. Additionally, consider diversifying your savings by investing in low-risk assets such as bonds or treasury bills. By diversifying, you're reducing your exposure to any single risk and protecting your savings from potential threats. Mistake 6. Neglecting life insurance for family security. Imagine this. You're the sole provider for your family and something happens to you. Your spouse and children are left without your income and are struggling to pay the bills. This is where life insurance can provide a safety net. Life insurance ensures that your family is financially taken care of in the event of your untimely demise. It provides a lump sum payment known as the death benefit, which can help your loved ones cover expenses such as mortgage payments, education costs, and daily living expenses. Without this financial support, your family might struggle to maintain their standard of living and could even face foreclosure or bankruptcy. So how can we fix this? Simple. Assess your needs. Determine the financial obligations and liabilities you have, such as a mortgage, loans, or other debts. Consider your income, savings, and your family's financial needs. By evaluating these factors, you can determine the appropriate amount of life insurance coverage to secure your family's future. It's crucial to ensure that your loved ones are financially protected in case anything happens to you. Mistake number 7, following investment trends blindly because everyone else is doing it. Think about the times you've seen people making investment decisions based solely on what others are doing, such as jumping into a cryptocurrency investment because their friends are making a fortune. While it's essential to stay informed about market trends, it's equally important not to be swayed by herd mentality. Blindly following the crowd without conducting your own research can lead to poor investment choices. For example, during the recent meme stock frenzy, many investors poured their money into stocks like GameStop and AMC because they saw others making huge profits. However, these dramatic price swings resulted in substantial losses for many who didn't conduct proper research. To avoid such pitfalls, it's crucial to focus on long-term goals and make informed decisions based on your own financial situation and risk tolerance. So how can we fix this? Simple. Do your own research. Don't blindly follow investment trends or the actions of others. Develop your own investment strategy aligned with your financial goals and risk tolerance. Remember, your financial success depends on the choices you make today. Don't let peer pressure or fear of missing out dictate your investment decisions. Stay informed, do your research, and invest wisely. Thank you for watching this video. Please subscribe and like the video if you found it helpful. Share your thoughts and experiences in the comments below. And don't forget to hit the notification bell so you never miss out on future content. Until next time, happy investing.